And I'm going to start on the far left side, your right side, and let Mr. Andrew Smith introduce himself.
Good morning, everyone. My name is Andrew Smith. I'm a tax partner with Cohn Resnick, a certified public accountant out of the state of Georgia. I work in our affordable housing practice and have been working in Texas pretty much since I started working at the firm as an intern. So I've been coming out here for a while.
Hi, I'm Janine Helverson. I'm an executive director with Wells Fargo Multifamily Capital, and we handle agency and HUD new construction and permanent financing.
Morning, guys. My name is Raj Bandla. I'm a partner at Baker Hostetler. We are a full-service law firm. I sit in the firm's affordable housing practice. I've been working in the space for a little over 10 years, primarily representing developers, but also representing syndicators, nonprofits, housing authorities. And we're really excited to talk tax credits with you guys this morning.
Yeah. And again, I'm Nathan Kelly with Blazer Building. We're a Texas-based developer, contractor, and a property management firm focused principally on affordable housing and developing through the 9% housing tax credit program. So let's get started. As you would have guessed, we're going to kind of take this from different pieces. I'll cover the developer aspect of it. They'll bounce questions to me. Raj will cover our attorney side, Janine will cover lender and investor, and then Andrew, the role of the accountant. So with that, just a little brief history, and we're not going to spend a ton of time on this because there's a lot of impactful information we need to get through this morning. But the Housing Tax Credit Program was born out of the 1986 Tax Reform Act. All of the tax credit program specifics are baked into Section 42 of the Internal Revenue Code. So, for some light reading, if you want to go dive into the Internal Revenue Code, that'll get you anything and everything you need to know to get started. Congress made this program permanent in 1993. And in 2005, the Texas Department of Housing and Community Affairs removed the low-income aspect of it. And so the state of Texas just calls this the Housing Tax Credit Program. A couple other points. There were some significant reforms following the financial crisis in 2008 and 2009. In 2017, there was an expansion of the tax credits. That expansion expired a few years ago. But as of the last couple of weeks, the Housing Tax Credit Program has seen a 12.5% expansion in the number of credits allocated to it annually. From a federal perspective, from a national perspective, another important change in the most recently passed legislation is rather than having to finance a 4% housing tax credit project with at least 50% of the project with bonds, you can now do that with 25%. We still have some things to work out here in the state of Texas for that to be applicable, but we'll get into all of that as we rock along. So what can be built using housing tax credits? It's anything and everything multifamily, right? So that's workforce housing for families. It's age-restricted housing for those folks that are 55 and older. In addition to that, it's single-room occupancy types of developments for those that are at risk of homelessness or experiencing homelessness. One of the things that I always like to encourage folks to do when you're new to the business, no matter what aspect of this industry that you're in, or if you're trying to educate folks on what it means to be a part of the affordable housing industry, is to actually get out into one of these developments, put your feet on the ground, just walk and feel exactly, what these communities are bringing or what these properties are bringing to their individual communities, and meet and talk with some of the residents. It is very eye-opening. It gives you an appreciation for everything that goes into putting an affordable housing development on the ground, and really just brings into perspective all of the benefits that these communities offer. Who can live in a tax credit community, right? So in a lot of instances, the properties are fully restricted for folks making below 80% of the area median income. And take all the notes you want. I should have started with this, but these slides will be available after the fact on the app. And in addition, if you want to go back and re-listen to any specific part, all of these are being recorded and live streamed. And so you can go back and kind of touch on key pieces of it at that point. I mentioned that the rents are restricted to folks living at or below that 80% of area median income. That 80% level is in conjunction with what we would call an average income approach to to qualifying income for folks. The principal target for qualifying for a housing tax credit restricted unit is 60% of the area median income. And that, in Texas, our 9% program covers really folks at that 30% all the way up to 60. On the 4% housing tax credit side, it's generally in that 60%. What you've seen in the last decade or so is a more mixed income approach to the development where, you may have 15 to 20% of the units at full unrestricted market rate rents, with the other portion of that, the 80 to 85% of the property at that restricted rent level. So there's two types, and I've touched on both of these a little bit, or I've mentioned them. We'll dive into the details of them. But there's the 9% housing tax credit and the 4% housing tax credit. They are two distinctly different programs. They're operated in very different ways. The 9% credit is a competitive credit, meaning that each year the state gets a certain number of 9% credits. That quantity is determined on a per capita basis. So the state's population kind of factors into how many 9% credits the federal government hands down to us each year. And then that bucket of credits is allocated on a competitive process, wherein each January developer teams submit a pre-application to the state for sites that they identified that they would like to submit a full application on. That gives them the opportunity to see how competitive they are relative to the other applications that are planned to be submitted. And then come March, then there's a full application that ultimately gets submitted to our governing state agency, which is the Texas Department of Housing and Community Affairs. And that competitiveness, that matrix that ultimately determines what that competitive framework looks like, is all baked into the state's Qualified Allocation Plan, or QAP. We'll talk a little bit more about QAP further on in the slides, but if you want to kind of know all the ins and outs of what's going on with Texas's QAP, I would encourage you to attend that QAP specific session tomorrow afternoon at 3 o'clock. It'll be on this floor in the AB room. And so that'll kind of give you an up-to-date refresh on all the things that the state agency is looking at in terms of making any policy changes to the QAP. Within that document, there are different subsets that you can apply for at risk in USDA or for those properties that are kind of at risk, as it would suggest, of losing their affordability. So they'll go out and look for a new allocation of credits to make needed improvements to the property, as well as prolong or extend out the affordability timeline. In addition to a certain subset of applications reserved for folks that are principally partnered by a nonprofit organization. And then the state's divided up into rural and urban subregions to make sure that the allocation of credits gets equally dispersed or evenly dispersed on both a rural and urban basis, but also across the state based on its population centers. And so much like the share of credits that comes down from the federal government is based on population, the state allocates them using what it calls a regional allocation formula, also based on that per capita target. So a Dallas-Fort Worth metro area, which is grouped in a particular region, would have a larger share than an Austin would, a larger share than a Houston would, but Houston being larger than in Austin and how those credits get allocated. Both of the credits are on a 10-year credit period, meaning once you get your allocation of credits, once you build your property, once you lease it to qualified tenants, then you're eligible to start claiming these federal tax credits. And we'll get into how all of this works from a financing component. But that initial run of tax credits lasts for 10 years. There's an additional 5 years of what is called the initial compliance period. So for a total of 15 years up front. And then beyond that, depending on the program, with the 9% program specifically, the full compliance or the full affordability periods are roughly 45 years per property at this point. New construction is primarily used for new construction. I'm sorry, 9% housing tax credit program is primarily used for new construction of affordable units, as well as the substantial rehabilitation of existing properties. And that can be a property that's already in the program, or that can be a property that has been existing and is just an investor's identified it as a potential opportunity to put into the program in order to take advantage of those credits to rehabilitate a property. The 9% program, as you see, is more lucrative. Essentially, the way the math works is you get to, and we'll touch on eligible basis when we get to the role of the accountant, but you take that eligible basis and you multiply it times 9%, right? So if you multiply it times 9 versus multiplying times 4, you're going to get a bigger credit allocation. But that bigger credit allocation comes with a lot more restrictions. And those restrictions typically entail more affordability. And so that 9%, because you're getting more credits, more share of the credits per the development in 9 versus 4, you're able to carry a lot less debt than you otherwise would, which helps to enable the greater degree of affordability. So where serving folks at 60% of the AMI on a 4% deal, you're generally serving folks in that 30 or 50 or 60 in a 9% housing tax credit deal. So the 4% credit program technically is not competitive. What the limiting factor is on our 4% is the state's bond capacity, because the 4% housing tax credit has to be paired with a bond in order to essentially facilitate its commitment to you. And we'll get into some more details there. But the state has a $130 per capita limit on all private activity bonds, also called volume cap, if you hear that phrase here over the next couple of days. There is a bond-specific intro panel that you can go back and listen to, and there will be another panel later today that's going to really dive deeply into that program as well. The 4% housing tax credit program is the most impactful in terms of the number of units, the sheer number of units that it creates. But again, those units are going to generally be at the higher incomes, right? And so that's 60% of AMI versus what you would call more of those units targeted to very low income. Because it's a non-competitive tax credit, doesn't have some of the other state policy objectives tied to it. And so where the 45-year affordability period comes into play on a 9%, the 4% tax credit affordability period is only 30 years, which is the federally mandated affordability period. It is also used for both new construction and substantial rehabilitation. But opposite of the 4%, right, or the 9%, it is a little less lucrative in terms of generating equity. And as a result of that, requires more NOI to service more debt in order to make these things financially feasible. And so that's where that interplay between the income restrictions on a 4% come in relative to the income restrictions on a 9%. If you have questions that pop up, feel free to load them into the app. We'll be kind of monitoring that throughout the course of the presentation this morning. And
Nathan, do you talk about subdebt in any part?
Sure. So generally, if you think about it, well, let's go back real quick. How many folks are brand new to the housing tax credit industry? How many folks are around the real estate industry, have an understanding of kind of how traditional real estate gets financed, but not necessarily the nuances of housing tax credit. Okay, fair enough. So traditional commercial real estate, right? A traditional multifamily property has debt and equity, and generally that debt and equity looks like, call it 70% debt and 30% equity. On a housing tax credit finance deal, let's take 9%, for instance, that's going to look more like 60% equity and 40% debt. That debt can be comprised of a traditional permanent loan, a mortgage, but it can also take into account other financing sources, whether it be from state produced sources like a state housing tax credit, or federally produced sources that are then handed down to the state to allocate, like community development block grant funding or National Housing Trust Fund dollars. All of these things that aren't necessarily that must pay first mortgage, but also help to bridge that gap between what the total cost of the development is versus what you can raise between your equity and your permanent mortgage. Okay. We touched a little bit on affordability requirements. There are two different paths. Generally, the path that most developers take in selecting these are 40% of the units at 60% of the AMI. What you will see is that largely on 4% deals, like I said, 100% of the units are restricted. On 9% deals, generally at least 80 to 85% of the units are restricted. On income averaging, 100% of the units have to be or have to kind of marry that AMI of less than 60%, as you see there. And then we touched a little bit already on affordability periods. I've mentioned the Qualified Allocation Plan and the QAP. This is the state's document that dictates essentially its policy objectives at the end of the day. It's what takes what's promulgated in state statute and distills it down into essentially a manual for how the state seeks to allocate the housing tax credits. So it has in there the scoring parameters for the competitive program. It has in there the minimum requirements across all of the programs, and whatever those percentage set-asides are, the different threshold requirements, and the like. And so each year, the state goes through this process of updating its Qualified Allocation Plan. It really has already started. TDHCA has hosted a couple of roundtables gathering public comment. They will post an initial draft, kind of what they call a staff draft, here before the end of summer. It'll go through a couple of rounds of public comment, and then they'll present that next year's Qualified Allocation Plan for approval to their governing board in October, November type timeframe, in order for it to be finally approved and signed off on by the governor in December. We touched on applications. That annual date per statute says that all applications have to be submitted by March 1st. And so depending upon how the calendar falls, that may be into February or early March. It is a requirement federally that the credits get allocated by July 31st, statutorily here in the state that allocated by July 31st of each year. And so you may all be wondering why TAP is hosting a housing conference in the middle of summer in Texas. Fortunately, we're all in here in the air conditioning, but TDHCA has its governing board meeting this Thursday, and that is the board meeting where it will allocate those credits, thus the before July 31st date. And so historically, this conference has always been tied into that governing board meeting where those 9% housing tax credits are allocated. So that's why we're here in July. These are the statutorily mandated scoring items. Chapter 2306 of the Texas Local Government Code, for some more light reading, if you're interested, outlines all of the parameters that the state agency must follow in allocating these credits. You can see those, they're ranked in order of how many or how much significance that the state legislature has placed on those items, right? So when you go through those scoring matrices of the QAP, you'll see the point allocation for financial feasibility higher than the point allocation for local government support, vice versa, all the way down to support from a state representative. Each of these is very nuanced. All of the information is outlined in the QAP. I encourage you, if you're new to the industry, that should be where you go. Go to the QAP, just dive into it. It's not going to be light reading, but it will give you everything you need to know about what's going to make a project feasible or not from the state's perspective. There are threshold requirements outlined in that document. You'll see, depending upon what they look like, that talks about minimum project size. It talks about different design requirements and what constitutes site control, right? So you can't submit an application that you don't control a site on. So you either have to own the site, you have to have the contract, you have to have the site under contract to purchase, or you have to have the site under contract for lease, right? So if you're going to ground lease the site, any one of those three would qualify you as having site control, which then means you are eligible to submit an application to the state for tax credits. Those threshold requirements also touch on the different levels of supportive services that need to be provided to the residents once the property is open and operating, what types of third-party reports you need to provide to supplement your application. You need to have already had conversations, and albeit preliminarily, with your lenders, your investors, arguably your attorney and your accountants, as Raj and Andrew would hope I would promote here, as well as having provided required notifications to local elected officials, which is all, again, part of our state statute. At this point in time, the most you can apply for on a 9% housing tax credit deal is $2 million per deal, and each development team can apply for up to $6 million in credits. So that would be essentially, if you maxed out, right, 3 deals per development team per year. There are some legislative initiatives to try and increase that per development cap. They were unsuccessful this past legislative session, failing to meet a vote by literally about 15 minutes, but we'll get into that in other panels, and we'll be back at it in the next session. So, from a developer perspective, what's the developer responsible for? The developer is the part of this team that is tasked with going out and identifying those sites that are going to be competitive or feasible, both from a QAP perspective, but also from a traditional real estate perspective. The developer is the one that's analyzing all of the different, real estate design and real estate fundamentals that ultimately make a deal successful, right? So it's one thing to be able to go and secure an allocation of housing tax credits. It's another to make sure that there's going to be demand for those units in that market, that you're going to be able to garner the support that you need from the local municipalities, from the state representative. It's another, to make sure that it doesn't have any environmental conditions or those sorts of things that would have a negative impact on the residents that are ultimately living there. So those are all of the different considerations that the developer has to take into account as it goes through its feasibility process. The developer is typically paid in these deals through a development fee. That development fee is capped at 15% of the eligible basis, plus or minus because of some formula stuff that is outlined in our QAP. But that is the principal compensation to the developer. Now, a bit of a caveat there. The developer, once it secures those tax credits, isn't just handed 15% of the eligible basis, right? It has to go put the full deal together. It has to design it, has to get it permitted, has to secure our lender and our investor, has to get the deal closed and under construction. And that developer fee is paid to the developer as it meets different hurdles, right? So a little bit of a fee at closing, a little bit of a fee when it completes the project, another piece of it when it is fully occupied by those qualified households. And then in some instances, to Janine's point earlier about subdebt, the developer will defer part of their fee into that compliance period and take it through cash flow. The developer can partner with other folks, whether it be nonprofit partners or the like, or historically underutilized businesses. There are point preferences within the QAP for partnering with nonprofits and for partnering with hubs, as I touched on. And so those are different considerations that developer is taking into account when they're putting together the deal team, alongside selecting our friends to my left, right? So, as part of that financial feasibility, that was that highest priority scoring item in our QAP and in our state statute. Every year, the U.S. Department of Housing and Urban Development hands down area median incomes for the regions and formulas for maximum rents. The state takes those numbers, the data that they're given, and then they produce a rent and income calculator essentially to make it easy on us to know exactly what the maximum allowable rents are for our metro areas. And then drilling down beyond that, we have some work with our local municipalities to figure out the utility allowances that we're have to provide to our tenants so that we can figure out ultimately what our math looks like from a rent perspective. Rents are capped at 30% of the income limit for each, right? So if you take, let's look at a 4-person household in the 30% bracket, the maximum income to qualify for that is $30,330, right? So then from there, they're only allowed to pay no more than 30% of their income towards rent. And so that drills down into how that ultimate rent amount is factored. And so it's imperative that you kind of use these tools that TDHCA provides to you. Ultimately, this is going to dictate what that income stream looks like opposite the expenses that you're going to have to pay, salaries and taxes, insurance, operating costs, all of those things to derive that NOI that ultimately supports the debt we talked about earlier, and that we'll dive into more deeply here in a minute. So what are credits worth, and really what's the point of the credit? We talked a bit, and we're going to dive in more deeply here, but let's just say that the cost to develop a project is $25 million. And you can see how this math works. Our eligible basis is somewhere short of that because things like land aren't part of eligible basis, and then other aspects of cost, and we'll get into more specifics, aren't part. So if we have a total development cost of 25, we'll say eligible basis is somewhere in that 20. 9% of that, 1.8 million, is what the annual credit allocation would be. That's 1.8 million in credits over a 10-year period, or a total of $18 million. And then our investor friends are going to pay some present value of that to us as equity. In this case, we'll call it 85 cents per credit. And that investor takes 99.99% of the deal, which ultimately ends up giving us $15.3 million in tax credit equity. Now, that leaves us a little bit shy of $10 million in other sources that we need to make up, right? And so you'll see because that equity is not all paid up front, the sources and uses and the capital stack looks a little different during construction and during that permanent period. And so during construction, you'll have a larger loan that ultimately gets paid down with those additional installments of equity. You may have some sub debt in there. You'll have that deferred developer fee that I talked about because it's also getting paid in installments in there. But then ultimately, as all of those other sources of funding come in, you'll have a much larger share of equity, smaller shares of debt. And then, if I've done a lot of what I'm supposed to do correctly, that deferred developer fee will get smaller and smaller and smaller as we get closer to closing into our permanent loan, and then paid out through our cash flow into the permanent phase of deals. So with that, I've talked a lot, and I'm going to hand it over to Raj to touch on what the role of our attorney friend is in this process.
Thanks, Nate. And so, in these transactions, the developer is usually the one who's really the nerve center of the transaction, and talking to folks like the attorneys, the accountants, consultants, and the investors. And where we fit in, we try to think of ourselves as a part of that circle of trust for the developer. And in a perfect world, we are brought in early on in the transaction, just to try to identify any legal issues from the onset and try to, really think through what a perfect ownership structure may look like, a fee structure, all of those good things. Our primary focus on these types of deals is going to be pretty similar than, to what you might see on any traditional multifamily deal or commercial real estate deal, in the sense that we're helping you deal with the purchase and sale process, helping you negotiate your partnership agreements, helping you deal with the lender's counsel, and handling all of those pieces, in addition to handling the issues specific to a low-income housing tax credit award. And with respect to the LIHTC program, there are really two sets of requirements we think of. One are the requirements under Section 42 of the tax code that deal with the overall LIHTC program, and then also the requirements for any specific state housing authority that is issuing credits. So in the case of TDHCA, Nate alluded to the QAP, some of the requirements that come after you've closed on your deal. Texas, despite being located in a state that has a reputation for being low regulation, I would say that reputation does not apply to the tax credit program. TDHCA has a very extensive list of requirements, and so we spend a lot of our time going through your tax credit application, trying to understand what points you claimed on your QAP and making sure that the structure of the deal is consistent with all of those requirements. In addition, it's exceedingly rare that you're able to finance a deal purely with debt and a tax credit award. As Nate alluded to, you have other sources of income that come into these deals, HUD financing, state programs. I'd say probably at this point, most deals in Texas have some form of a property tax exemption that are attached to them. And so our job is to make sure that your deal is complying with all those different sets of requirements, and we work with all the different parties in the deal to make sure that the deal, satisfies all of those requirements. And so in the course of making sure that the structuring is consistent with those requirements, will also help you negotiate your loan documents, equity documents, and all the normal documents you would see in any multifamily deal. So as Nate mentioned, in a perfect world, hopefully you're talking to us early on in the process, along with your accountants and your consultants. Even items like site selection, which may not seem like a tax credit related item, do run into issues with QAP. There are TDHCA guidelines regarding how many tax credit developments can be near each other. You may get certain points for having a development in a certain location. And so those are the types of issues you want to bring us or your consultant or your accountant in on early on. And then through the application process and really through the closing process, that's probably when we're the most involved in your deal. After you close, TDHCA still does periodic audits. You'll still have potential issues if you're in your lease-up phase and you're trying to make sure that you're remaining consistent with the requirements that you agreed to. And so even though we close on a deal and we're mostly out of the picture at that point, it's pretty normal for you to have to bring in your counsel really throughout the life cycle of a deal up until you actually get to an exit event. So some issues that come up over the course of a deal, as Nate mentioned, you have a lot of requirements that come up in your QAP different opportunities to claim points. And so site selection is an opportunity where you may be able to either get extra points by picking a certain location that TDHCA wants to incentivize developments in. There are also certain locations you may want to avoid. And so this is a good opportunity to bring us in and go through where you're thinking about locating your project. The QAP process, we often come in at the application stage and just advise on what types of requirements, what types of opportunities for points you would have. And also with just selecting financing partners, this isn't really a legal issue, but we work with a lot of investors, a lot of lenders, a lot of different agencies. And so, over the course of all those deals, we just have a good sense for how different types of organizations work, which types of investors or lenders might be a good fit for your organization or might want your type of development. And so not a legal issue, but just something that we're able to advise on in addition to any legal issues. And of course, just assisting with all the blocking and tackling that comes with putting together closing documents, running your due diligence, and doing, all the normal things that you would need your attorney to do on any multifamily or commercial real estate transaction. And like I mentioned, after you close, compliance issues come up all the time. TDHCA is very thorough in its post-closing reviews of deals. And so typically every 2 to 3 years, you can expect some sort of inspection from TDHCA just to make sure that you're delivering on what you promised to them. In addition, we'll come to assist you at permanent debt closing and also when you're getting ready for an exit event. Often those year 15 transactions involve TDHCA approvals for whoever your buyer may be. A lot of times our developers may want to re-syndicate at that time. As Nate mentioned, just because a property already has received a tax credit award doesn't mean it can't receive another. And so when you get to year 15, a lot of developers see that as a good time to put a capital infusion into the deal. And so we can assist you with applying for another tax credit award at that time or helping your buyer just jump through all the hoops that they need to jump through to get into your deal and take you out. In terms of the legal roles for each party in a deal, in a typical plain vanilla LIHTC deal, the developer will come in as the general partner or the managing member, and they'll be responsible for running the day-to-day operations of the property, overseeing the property manager, overseeing any, refinance or recapitalization events. And typically they're paid through a developer fee, as Nate mentioned, and they will also normally get the lion's share of any residual cash flow or proceeds from a refi or sale. The limited partner, that's going to be your tax credit syndicator. They will come in as a passive limited partner, and in exchange for their equity infusion, they will obviously get the tax credits. They also will get the lion's share of any depreciation and other tax benefits. And in addition, they typically get an asset management fee that comes as a share of residual cash flow or refinance or sale proceeds as well. Now, this is what you'll see like I said, a plain vanilla ownership structure look like on your tax credit deal. You have the owner entity, you have the developer as a general partner, investors a limited partner. In Texas, as I mentioned, probably at this point, the vast majority of tax credit transactions have some form of a property tax exemption that's also included as part of the structure. Those come with their own set of structural requirements. Just generally speaking, what that means is that you will need either a nonprofit partner or a government agency partner as your general partner. They're not normally running the day-to-day operations. Your developer entity will serve as a special limited partner and still be running the day-to-day operations for the most part. But the nonprofit or agency partner usually needs to be in the GP role in order to satisfy the legal requirements for the tax exemption. A lot of times, this also means that your agency partner, your government agency partner, will also have a purchase option or a right of first refusal on the property as well. I won't get into the details of how we address that, but feel free to come talk to us after if you'd like to go through that. There's also a couple of panels tomorrow afternoon that discuss these specific property tax exemptions, and I'd encourage you to attend those to learn more about those exemptions and how they work. But just so you know that this type of structure is pretty common for Texas tax credit deals these days. And so this is how one of these deals would look with that tax exemption applied.
A little less plain vanilla.
Yeah, and unfortunately, this is what passes for plain vanilla in Texas these days. You'll have a ground lease that from your government agency partner into the tax credit partnership. You'll have government agency partner sitting as a general partner. Your developer moves from the GP slot to the special limited partner slot. The investor gets to do what they do and still be the investor limited partner. This looks a lot scarier than it is, and it is pretty normal for an investor or developer the first time they're doing this to have a lot of questions and concerns, which are pretty understandable. I'd say 99.99% of the time we're able to work through all of these issues. It just takes a little educating of your sponsor, of your investor, and we're, at this point, we do these deals pretty easily. So like I had been saying a couple of times, I think I try to think about these tax credit transactions from a legal perspective as just a normal multifamily transaction with a tax credit element attached on top of that. And I think if you think about your transactions that way, that'll help alleviate a lot of the, stressors that come along one of these deals, because there are a lot of them. I do want to use this slide as an opportunity to highlight some of the, additions that come with a tax credit deal. So every tax credit deal will have what's called a land use restriction agreement. This is an agreement that the tax credit partnership signs with the state allocating agency. So in Texas, that would be TDHCA. This agreement in most states will last for about 30 years. In Texas, it can last much longer than that. It's 45 to 60 years in some cases. And this is where you're simply agreeing to all the things that you promised in your tax credit application. So you're going to agree to the income and rent set-asides that you promised in your application. You're going to agree to certain ownership structures. So if you agree to bring in a nonprofit, then your tax credit land use restriction agreement will cover that obligation. There will be certain restrictions, especially in Texas, on what types of entities you can transfer your property to. So on a 9% deal, for example, there may be certain restrictions on disposition that only allow you to transfer the property to entities controlled by certain types of nonprofits. You'll have a development agreement. This will look pretty similar to any development agreement you might have on your normal multifamily deals. One wrinkle that will come with a tax credit deal is that a lot of times you'll see the tax credit investor have a preferred form of development agreement. And the purpose of this is to make sure that the developer is complying with all of their requirements under the tax credit program. This is also where you lay out the conditions for getting each installment of your development fee. So as Nate mentioned, on a tax credit deal, you don't receive one fee upfront. You receive it in installments for hitting certain milestones. And this is where that gets laid out. On a lot of deals with a nonprofit partner, you'll have a purchase option and right of first refusal agreement. Which is exactly what it sounds like. the nonprofit partner will have a purchase option and a ROFR, an asset management agreement with an investor addendum. Most syndicators have a preferred addendum that they like to attach to the asset management agreement. Again, this is to make sure that whoever the asset manager is meeting certain requirements of the tax credit program. And in a lot of cases, the requirements of that syndicator agreed to in its fund agreement with its investors. The partnership agreement, it will look pretty similar to what you see on a lot of your other multifamily deals. It will have some additional terms that you don't see on a traditional multifamily deal. For example, you'll see what's called a repurchase obligation section. And this is essentially a set of events that would require you to have to buy out your limited partner. So, and these are, I would say, like pretty severe events. So, you know, not completing your property in time to qualify for tax credits, not leasing up in time to qualify for tax credits. If you're running into a repurchase event, I would say you've probably got bigger problems than losing your investor. It probably means that something has gone, very wrong. You'll have what are called adjuster provisions. And so these are provisions that require essentially a resizing of the capital contribution based on either qualifying for fewer tax credits than what you promised your investor or receiving them on a later timeline. And so, this comes up from time to time on a deal. If there's a delay in getting to completion, a delay in getting to lease up and the time, and, therefore the time at which you can claim credits, then, you will see some adjusters on a lot of deals. And that will, lead to some, small gaps that you may need to fill on a deal. We covered the installment-based developer fee. The capital contribution schedule, this will be something that gets heavily negotiated over the course of a deal. Normally, this will be for things like hitting 50% completion, 100% completion, also hitting your what's called an 8609. So this is where you receive your paperwork from the IRS, essentially confirming that you're qualified to claim tax credits. You'll also have operating deficit and development deficit guarantees. The operating deficit guarantee will typically last through the 5th anniversary of your stabilization of the property. So if it's a new construction, this would be typically 5 years after conversion, or on an ACC rehab deal, it would be 5 years after hitting your traditional markers of stabilization. So hitting a certain DSCR, occupancy requirement, those types of things.
All right. Do you want to?
Sure.
Okay.
Just with
The
this.
big room. Okay.
I'll cover the role of the investor and the construction lender and the permanent lender. Wells Fargo specifically is a direct investor. And so Raj just covered that the limited partner is going to take the majority of the ownership of the transaction for the credits and for any losses and depreciation. And they are looking for that piece first, and then the general partner will be taking the cash flow. These investments, as I said, Wells Fargo is a direct investor, but they also can be made through a syndication vehicle where there would be multi-investors or a single proprietor investor. And so there are some advantages and disadvantages of obtaining direct and obtaining a syndicator. On syndicators, there may be provisions where one of the investors may want to handle the construction financing or the perm financing. Direct investors want to handle the entire capital stack. But there is just structuring issues that pop up between either direct or syndicators. What's important is really just engaging with those folks early, just to get an initial idea on what price per credit would be for that market. I would say we get about 50% of our requests come through just a regular RFP. But it's very relationship based as well. So we have people reach out and, share their pipeline with us so that we can talk through, what deals are advantageous or ideal for whatever needs that the bank or an investor would have. So dovetailing on what Raj said in the legal documentation portion, but then investor is the price per credit that the investor is going to pay will be based on a number of different factors. So it's not just the price per credit, but the negotiation will have everything to do with the timing of the pay-in schedule of when those capital contributions need to be paid, the adjusters that Raj talked about, when developer fees are going to be paid. Investors like for developer fee to remain in the project in case there are any construction overruns, there is money available to pay those. The cash flow waterfall, the reserves, the guarantees, and who's providing those guarantees. Are they individuals? Are they corporate entities? That's going to be really important in the discussion. Asset management fees, regular management fees, and then what are the exit terms at the end of the compliance period in year 15. The amount an investor will pay could be wildly different between investor A, B, or C. You could see, 1 cent, you could see 8 cents, 10 cents per credit. And it's really dependent on a number of factors, but it's really how much that investor wants that transaction. But they are looking at the financial strength of the developer and their experience. Kind of the old adage, the more money you have, the more money you can get in a tax credit deal, because the investor knows that you have deep pockets and you can cover any overruns if there are some. The other part would be the location of the development. There is a strong need for CRA credits. In fact, for my financial institution, we are nearing the end of our compliance period, although we were just told that it's extended by another year. But we have been very focused on looking for deals in the CRA market. So, for example, for Wells Fargo, wherever you see a number of Wells Fargo local branches is where we are typically going to have a large CRA need. But that's going to drive a lot of our credit price and deals that we are actually, being aggressive on pricing. There's needs to be a strong market for that proposed housing and for the size of that proposed transaction. In more recent times, we're starting to see a lot larger transactions, which in some growing populations is a little disconcerting, but we are paying close attention to that. And, it's dependent on new construction versus rehab, and a lot of that has to do with the timing because the rehab is usually a shorter construction schedule. And then just in terms of the timing of the capital contributions, the more money that equity is coming in, the kind of lower dollar price that has. So you're kind of a balancing act between your interim financing or your construction financing. And then that, has implications like interest payments and things that the developer is trying to constantly balance. But then, importantly, like time is money. And so, in a very slow moving process, we have a preliminary conversations with developers just to get pricing and timing. But we may not see your deal again for a couple of years. So it's important just to establish those relationships early. So these developments will need a construction loan and a permanent mortgage. The construction loan will be dependent on the construction time period, and then your permanent mortgage will generally, there are some wild programs out there, but it'll generally have a 16 to 18-year term with a 30 to 40-year amortization. We have even seen some private placement programs move to 45 years amortization. Again, these lenders might be the same entities or they might be different entities. And on the construction and permanent kind of underwriting, we are looking at the strength of the borrower and their track record, liquidity and net worth, again, the experience and the number of units that they've developed with this type of product. We are considering your pro forma. We're taking a look at, comps in the area to make sure that your expenses are in line with that type of product and market. And we're also looking at what the rent advantage is to market, and also, not just for your tax credit rents, but also for those market rents that are prevalent in Texas deals. We are looking at your market study and appraisal to make sure that, your cap rate is justified and that you've got a solid absorption and capture rate for each of the unit types. We are also looking at your environmental report to make sure that we have a clean site. If there are any environmental issues, what's the appropriate mitigation? What's the path? It's important to note that we must approve the general contractor, and what we are looking at is the strength of that general contractor and how much liquidity they have with what they're working on as well. So we're evaluating their works in progress to make sure that they're not over leveraged and that they can complete your project in time without having difficulty or strain on their balance sheet. On the permanent mortgage side, we're looking at how much debt can be supported by your income. So again, we're looking at, your unit mix, how much, what band of incomes you're targeting, your expenses. We're evaluating what the current interest rate is over the term. Most debt service coverages are somewhere between 115 and 120, with a max loan to value of 85% to 90%. And then some lenders are using a debt yield calculation as well. The permanent loan products that I cover and that are very prevalent in the industry are going to be both Fannie Mae and Freddie Mac. They both have a forward program where on a new construction or a substantial rehab too, you will close a forward commitment at the time of construction closing. And then at the time when you're stabilized for a certain period of time, you will convert into into that loan, but that your interest rate is locked at construction rate, and then it's converted after you've stabilized. So they both have the forward 9%, and then they both have a forward 4% transaction. FHA also has a taxable new construction and AC rehab program, And that's used in conjunction with a short-term bond collateralization on the 4% transactions. Those are on the new construction side, you have a construction loan, and then that automatically converts to a permanent loan. In those situations, you may have to have an equity bridge loan from a construction lender in order to right-size that construction period with the perm loan period. There's also a private placement program, and I didn't include this here, but for smaller 9% deals, we see a lot of just traditional bank financing from like local and regional banks will provide financing for those transactions. I love this slide on the interest rate environment because if I knew the answer to this question, I wouldn't be on this panel. But you know, it's as of last Tuesday, it's still the market's still showing that there are tariff concerns, and it appears that that has erased any potential cuts in July of 2025. So we are possibly looking at a rate cut in October or December. But a lot of that is going to be driven on what the labor market is doing, is unemployment data ticking up, and is inflation lowering. But I would encourage, you know, lenders are always happy to discuss your projects. And so you can reach out at any time to inquire about, you know, where we are seeing rates so that you can plug that into your pro forma. We can talk about how much you should cushion, kind of what's going on, when are you going to lock. Those are, you know, important to understand so that we can kind of talk through what you might see for a rate.
All right, so I got the last section here in the fun part, the role of the accountant. I'd say when everybody starts thinking about the role of the accountant, the first thing they think of is tax returns. They immediately look at that and start bringing up that topic, which of course is important, but we do a lot more than that. We're specifically involved in a lot of these projects from the start to the finish. The more you complicate these structures, as Roz alluded to, the different debt and Janine introduced you to the different debt sourcings. When you bring in grants, there's a lot more need to look at these projections up front and make sure that the projects will deliver credits on the terms they're supposed to. You don't have any reallocations. Over the last 3-4 years, I've seen a lot more of that pre-upfront projections where we come in and consult on the allocations, especially when you start involving grant income and potential issues that come associated with that. But I mean, of course, we're also involved in all the other processes as far as the filing and compliance of the project. We're generally involved in deal structuring up front, your tax planning, which is what everybody thinks of, your exit strategies, which we know we have another panel on, I believe tomorrow, that discusses year 15 and getting out of these projects. There's a lot of factors involved there as far as getting the final buyouts, getting everybody out of the deal and moving the project forward. We're also involved in keeping up with changes in the industry, which I feel like is a full-time job now. This is the second tax bill we've had now in 8 years. And it seemed like every time we have a presidential turnover, they're changing the rules. So it is definitely getting challenging to keep up with. So you definitely have to talk to your CPA on a regular basis, especially after these new bills pass, because there's just a lot of little details in there that may catch you on the back end or surprise you later on if you're not aware they're coming. All right, how do we move this forward? There we go. Like I said earlier, the other items we assist with audit and tax returns. When it comes to tax credit deals, we're dealing with credit specific reports. The 10% report, which I'm going to cover in more detail, that's specific to 9% deals. The cost certification report, which is actually the report filed with the state, with the TDHCA, that will get you your 8609s, your allocation of credits, the ultimate piece that everybody is working towards to make these deals function. We also do bond specific reports. Was the 50% test, now it'll be the 25% test. And I'm sure there's a lot to work out as far as that goes. 95.5 test, arbitrage calcs. We're also involved in various other reports. If you have cost segregation studies on a project, if you've promised your limited partner certain depreciation amounts, there are reports you can do to enhance that and deliver more depreciation. I'm sure that'll come a little bit more popular with the expansion of bonus depreciation to 100% in this new law going forward. Additionally, lease testing, credit adjusters, debt service coverage, and qualified contracts. So pretty much if there's a report that's being filed and associated with the program, we're who you're talking to. So the first test I'm going to cover, which is specific to the tax credit program, is the 10% report. This report is very important to get timely filed. As I said earlier, we discussed the difference between 9% and 4% deals earlier. The 9% deals are competitive, and when you get that carryover allocation, you generally have a 1-year period from that date to get these projects in service, unless you file this 10% carryover report. So this report specifically requires that you show to the state that you've incurred at least 10% of the total basis of the project by the end of the first year. It is very important on a 9% deal that you're looping in your CPA with this as soon as you're aware. There are a lot of deals where delayed closings or items in the project may bring this up to where you're actually not even really getting started on construction until right before this due date. The sooner you loop in your CPA to the problems you have, the more likely you are to get in front of them and incur those costs. I'd say this has definitely happened more in the Texas market specifically, as Roz said, with the use of the ground lease functions. You know, on the old deals, when you actually bought the land, a lot of times that met your 10% test right out the gate. With a ground lease, especially an operating lease, you don't have that. So you're working strictly off your construction costs, your architectural engineering fees, your developer fee, which you can usually take 20% of, as long as you've gotten the closing done. But again, like some of these bigger projects, it can be challenging to try to run that up, especially if you're running down to the last 2 or 3 days. And the result of missing this 10% filing would be potential loss of credits. So it's a big deal, and make sure you're not forgetting about this and coming in after the fact. We've seen, at least over the last few years, it seems like every year there's somebody who doesn't know about this and doesn't engage somebody and misses their deadline, and big problems. So when I say about 10%, I was going in earlier about how you have to incur 10% of the basis. The actual calculation itself consists of 10% of the reasonably expected basis, so not your eligible basis. So if you have land, like I said, or your architectural fees, that has to be greater than 10% of the total basis in your application, essentially. We also generally test it as 10% of your revised basis, because usually between application and usually a year into the project, your costs have gone up a lot. But the goal there is to get 10% of that to get that carryover allocation. Simple formula, but easy to mess up and big problems if you do. The next topic I'm going to discuss is the cost certification. This is probably one of the biggest reports outside of just the yearly tax filing to claim the credits. Is the report you file where the accountant will certify your total eligible basis of the project. On the 10% board report, I missed reasonably expected basis. That can include land. This is actually testing for what is credit eligible. And we'll cover kind of in detail some of the topics or some of the items that are credit eligible. In general, it's pretty much anything that'll end up in your depreciable basis. You know, if it's non-depreciable, it's not eligible. The reports vary state to state. Every state has their own format for this. So, you know, Texas has a very specific format they're looking for. Every state in general requires kind of the same pieces. They want a schedule of your total cost with a schedule of the eligible basis that's calculated. They want a calculation of credits. They want a summary of sources and use of funds to make sure your project is not oversourced. They want a gap analysis, and generally you'll see a pro forma attached to these. Again, like these are very formatted. Once you actually get to the final package and put them together, they can be significantly long packages to submit and a bit of a headache, but this is the last step to getting your 8609s for where you can actually claim the tax credits. So from the CPA perspective, I'm going to go on a little bit more on eligible basis. Again, like I said, that's typically your depreciable basis in the project. It can include common areas. So if you have common areas in the multifamily complex that are available for use by all of your tenants, that basis is included. Another common item you see in here is what's known as a QCT or a DDA basis boost. This is a qualified census tract or a difficult to develop area. These are mandated by the Fed. The government actually puts out a website that has a listing. You can look up and see whether any project is in this area. And what these are designed to do is to give you a basis boost on top of what you actually spent to help fund additional credits to help make these projects more feasible. So for example, if you're in that area and you have a bond allocation, you would have earned $1 million in credits. You've spent $1 million in depreciable assets. If you're in this area, you get a 30% bump, and now you're earning credits on 1.3 million of basis. That's a really low number, but just general concepts. So that boost can help generate more credits and make these harder to develop areas function. So again, going back to eligible basis, like I said, depreciable basis, these generally will include your building acquisition costs, your construction costs, your impact fees, appraisals, your FF&E, any items that are done with building the contract. Some of the more complicated items are interest expense. I will say this has been an area of increased complication over the years, specifically with the new tax laws limiting interest that have now come into play going forward. Also with the fact of the elections available as far as capitalizing interest. If you have not taken a good look at your pro formas and you are close on basis, you want to get with your CPA early and see what elections you can potentially make to capitalize additional interest. There is a 263 II election that allows you to capitalize almost all of your interest, but there's negative impacts to that as far as recognition of interest income, and as far as lost expenses that potentially could upset the investor if it's more than expected. But this area is increasingly complicated. So, and honestly, it's like it can vary deal to deal. You have to look through it. It's a long, complicated calculation. So if you think there's issues there, look at it. Sometimes, a lot of times, what I've seen come across is you'll have a very basic pro forma that just assumes interest capped at a standard rate. Then you actually get into some complicated acquisition structure, and it doesn't come out how it was planned because nobody took a deeper dive into it. So again, just one of the items I strongly recommend that, if you're looking at your deal that's close, if it's 9% deal and it's way over basis, probably not an issue. But an AC rehab deal, these can come into play a lot. Another item on there is the developer fee itself. That is usually a big chunk of your basis. Every QAP, if you read through them, for every state has a limitation on this. So depending on the cost of the project, you'll have to run a formula, and if the developer fee is over that, you'll have to reduce it. So that's another item you kind of have to watch out for. So costs that are not included, like I said, these are your non-depreciable items. They're your land, they're your reserves, they're your permanent loan fees, your syndication fees. Commercial income producing space is becoming more and more popular as an item that's come up here. A lot of developers have been developing more of these live, work, play concepts where they have retail, where they have food chains in there. Keeping in mind that you have to watch how you're allocating these costs, because any of those commercial producing items are ineligible for tax credits. A lot of times what I'll see is they'll take those pieces and silo them in a different partnership and pull them completely out of the credit deal. But if they are in the credit deal, you have to make sure you're looking at the details and not violating any of the other rules involved.
But Andrew, even like garages or carports or whatever else, right?
Agreed.
If it's included, those can be included in the eligible base, but at that point, you're restricted from charging on them. So if you want to be able to charge for those types of amenities, you have to make sure that they are excluded from your eligible basis.
Yep. And same the coin operated lot, but pretty much anything you can think of that you can produce income on. The key factor is it producing income or is it for the benefit of the residents? As far as the cost certification, the other items we have to look out are the maybes. One of the big items here that's been kind of popped up across a lot of states is tenant relocation. Texas itself does not allow tenant relocation cost as part of eligible basis. And there's a lot of states that are saying that. And anytime you deal with accountants and CPAs, I feel like the problem everyone complains about is that you ask us any question and our answer is always maybe. And it just comes down to the difficulty of the tax code. As far as tenant relocation costs, which is a good example, the tax code itself and the uniform cap rules in some case and scenarios will suggest that that should be capitalized in depreciable basis. But then the audit technique guide for the tax credits itself actually says that it should be excluded. So we have two things kind of going hand in hand, which is why you have this scenario where this cost, some states are saying it's not involved, it's not included, and other states are saying it is. There's always something like this coming along. We've tried to get clarification from the legislative body on that, but just one of the many issues of maybe. Other issues, accounting fees, generally your accounting fees for the LP itself, cost certification cost, that's eligible. GP fees, syndication fees, stuff of that, that's all excluded. Same thing with legal. Generally, your attorney will give you a letter that tell you what is part of the eligible basis, what actually related to the property versus what wasn't. Generally you see in the 60 to 30, 75, 25, just depends on where the work has been done. Acquisition interest, my favorite topic. Interest again, interest expense is just always a fun deal to deal with. Construction loan fees, real estate, environmental, again, all these are maybes depending on the facts and circumstances. So again, getting with your CPA early, if you're worried about basis, if you're afraid you're coming up close is important, because that cost certification process can separate out these items and determine how we're getting to the correct basis number. So this all brings us down to the final piece, which is the credit calculation. And this is the piece that everybody's interested in, the investors paying for, and how these projects are getting funded. The credits themselves are generally earned over 10 years. The compliance period for the credits is 15 years. So what I mean there is that generally, as long as you're fully leased up at the end of the first year, you're going to claim the credits over a 10-year period. But if you violate the affordability provisions at any point between year 1 and year 15, you could lose those credits. So if you went all the way to year 15 and violated it in January year 15, you can effectively lose 1/15 of the credit for that unit. So just because the credits are done at year 10 doesn't mean that you can just stop worrying about the compliance issues. There's also special rules for the credits in the first year of the credit. And we'll have I'll run through an example on that. Essentially what you're looking at is if you have a tax credit period where the credit is starting, say, this year. The project was in service in January, but you didn't actually fully lease up till, say, July. And let's say it's a fluke, you'd lease the whole project up July 1st, just for simplicity. Then you would only get 50% of the first year tax credit. So if you were earning $1 million in credits, you'd only get 500 in the first year. And that will contribute in part later, which I'll discuss, which comes in some of the adjuster calcs. So this is a very basic example of how those calculations are come. We used a 9% deal here so you can see the effects of excess basis. But if essentially what you're doing is you're going through the calculation, you're figuring out how many units were leased up for each period, each month, and then using that weighted average times your basis times your credit rate to get what your credit is for that first year. When there's an acquisition deal, when there's a new construction deal, you cannot begin credits before the first of the month following acquisition. So say you acquisition. Yeah, that's right. So acquisition deal, say you placed in service January 18th, you cannot begin claiming the credit until February for that month, because the January 18th was it was after the first of the month of January, so you can begin February 1st. For an AC rehab deal, the credits can begin either the first of the year or the later of the first of the year or the acquisition date. So say you bought a property January 12th, you did the rehab and finished your rehab, got your substantial completion in September. You could actually claim credits starting in February if you did a rehab around tenants. It just has to be after the date of the acquisition. Now, all of that comes back to, I know Raj discussed adjuster calcs, so we're going to discuss those in a little bit more detail here. The operating agreements always have provisions in there as far as promised delivery, as far as total credits you're expected to deliver, plus total credits you're expected to deliver in the first credit year. A lot of times, I've seen where most top, it's usually perm adjusters aren't as common. We still see them with the 9% deals. On the 4% deals, sometimes they pop up more often. The timing adjuster is the most common issue to where you see loss of funds. Essentially, what's happening here is that you may have promised a certain amount of credits to be delivered the first year, and you under delivered, so that's going to affect your equity. Just a couple of brief examples. Like I said, so the perm adjuster, a lot of times you'll see this on your bond deals if they did not deliver enough cost, or if you delivered over cost, you could potentially have an upward adjuster. So what you effectively have is, say you promised to deliver $750,000 of tax credits per year to an investor. When you actually got done with your year cost certification, you went through all your eligible basis, you excluded your costs, you determined you only earned $700,000. So in the operating agreement, there's a provision that effectively reduces the equity your project's going to get because you didn't deliver what you said you would do. So in this case scenario, you delivered 50,000 less credits. That's over 10 years. So you have 500,000 in credits that you underdelivered. The investor was a 99.99% holder. So you underdelivered 499,950. And then there's a rate that's multiplied by. In this case, we assume 90 cents per dollar. Effectively, you're losing out on $449,000 of equity that now you're going to potentially have to plug somewhere else. Although maybe the cost of it are down enough to where it's not an issue. It depends. The next one is the timing adjuster. So the timing adjuster is, again, going back to that, what you promised to deliver at the beginning of a period. So say you had a project, you were going to deliver you said that you were going to deliver permanent credits of 750,000. You only delivered 7. Well, you're not going to account for the fact that you've already accounted for the permanent adjuster. So in the timing adjuster, you'll start with 700,000. You promised to deliver 350,000 of credits in the first year. Or sorry, the actual first year delivery was 350,000. You promised to deliver 700. So you're 350,000 short. So what you do then is you take that 350,000 short times, again, a rate that's pre-specified in the operating agreement. In this case, we'll assume 65 cents. It's usually based on some sort of formula of the time value of the money of delivering a credit in year 1 versus if you don't deliver it in year 1, it gets pushed back to year 11. So in that case, the downward timing adjuster, if you run through that formula, would be about 227,000. So the result of the shortfall of the 2 adjusters here is almost $700,000. So again, keeping track that, that's the effect of not delivering what you were expecting to deliver. I believe that is all I have. Of course, if anybody has any questions, feel free to ask.
Yeah, Andrew, and I'll add on the timing adjuster piece of it, and we all kind of touched on this individually, right, in terms of when each party gets involved. But that timing adjuster, that credit that you're promising, is essentially based on your expectations of how long it's going to take to construct and how long it's going to take to lease up to deliver those credits, right? So that's part of the negotiation with your investor. That's where that consultation with your attorney and your accountant come into play. On the attorney side, what are they seeing in other deals? On the accountant side, really, if that lease up projection is feasible in terms of how many credits it's going to deliver in order to meet that projected credit delivery in that first year. So with that, we'll open it up to some questions. We've got a mic over here. Raise your hand. We do have one question sitting in the queue that I'll start off with and address, and it's on a partnership between a hub or a nonprofit. How is a tax abatement achievable with this structure? So generally, in order for, and on the nonprofit side, it's going to more or less be a community housing development organization, a CHODO, as otherwise called. And a CHODO in most counties is eligible for a tax exemption, but they have to be the general partner of the entity, right? So the non-CHODO aspect of that, right? So a for-profit developer can come in and be a special limited partner, an assisted administrative limited partner, or some other non-investor limited partner element of the ownership structure. And Raj, weigh in here if I'm messing anything up. But that is generally that structure that would then qualify the partnership for that CHODO exemption.
Yeah. And I think the only thing I would add is that abatement will have its own affordability and rehab or construction requirements on top of it. So you'll just want to make sure that you're being mindful of those requirements as well.
And it's not a full real estate tax exemption like you would find in the ground lease structure that we touched on earlier, but that would typically be found through a housing finance corporation or a public facility corporation, or even a public housing authority can offer one of those full real estate tax exemptions. Shoto exemptions generally going to be taxing jurisdiction specific, right? So the county's taxes you would be exempt from, but not necessarily the school district or the municipality, the city. We got other questions? I know there's a lot of in-depth information that we all covered, but happy to tackle anything else you guys want to visit about this morning.
There's a question.
Click to the contact sheet. One more. Yeah, there we go.
Hi, thank you so much for this panel. My name is Farheen. I'm still pretty new to all of this, so I apologize if I missed it, if you said it, but I have a pretty basic question. So if we're looking at AC rehab instead of development, do you still have to have ownership of the building the way that you would with land? And then in a similar way, what is excluded if you don't need land? Is it still everything, the same things that are excluded for development, just minus land?
Andrew, you want to take that?
Yeah. So I mean, you do have the AC rehab. You have to own the building the same way as you would normally. You're going to buy the building, and the only difference is going to be is that you're going to do a substantial rehabilitation of it. As far as the land can vary. The land can be a lease set up. It can be owned. Like I said, usually in Texas, we see the lease set up for the property tax exemption. But yeah, the AC rehab structure is generally the same as new construction. The only difference is that instead of building from the ground up, you're doing a substantial rehabilitation that meets a certain threshold under the IRS rules.
Andrew, are there any elements of the allocation, like when you're acquiring an existing deal, how do you go about determining the allocation between building cost and land cost?
So as far as building land, appraisal obviously is the best bet. If you can get an appraisal between the building and land, that is the most foolproof. You see scenarios where people will use tax bills and stuff to split them. But again, like that could be more challenging. My recommendation is always have an appraisal to split it. It just cuts out all the X's and O's. But there are various ways you can do it if you don't have that.
Thank you for that. Any other questions? In the back. Kim, in the back.
I didn't
Oh,
see
in the
that
back,
at all.
sorry.
It was a baby.
Follow up to that, if it is an acquisition rehab and it's a conversion, say you're going to take a strip and turn it into residential, let's do a 55 plus, you can't get a comp that it doesn't exist. So is there any other insight into how that can be derived?
I mean, really, it's going to have to be facts and circumstances. You're going to have to look at it. You're going to have to take, if you can't get a straight comp, you're going to have to try to take a reasonable guess using whatever metrics you may have available. It just depends on what stats are available for the area. Maybe you could look at surrounding areas. Outside of that, you'd have to look at the math, the appraisals, potentially see what the math works in there, see what local land is around it. That makes it more complicated, but there's no definite answer. You'll just have to look at the facts and work through it.
Yeah, big donut.
All right. One last call. Anybody? Well, just as a reminder, this session has been recorded. It will be available for you to go back and take a peek at if you've got any follow-up questions. We'll be here for a couple of minutes as we wrap up. And I want to say thank you to each of you for coming and learning a little bit more about our industry that the four of us have dedicated so much time and energy and effort to, and that we love dearly. And thank you to my fellow panelists for contributing this morning, adding a lot of value to what TAP is doing here at the Housing Conference. So thank you.
Thanks, Nate.